Price. That's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Today, I welcome back Trevor Neil, a trader for over 50 years, having started out trading commodities with Merrill Lynch in the mid-1970s. We first spoke in April last year, and Trevor has since appeared on the show to discuss his innovative new trading product, the RRG UK Momentum Plus. Links to both of these interviews can be found in the episode description. During today's episode, we discuss the market mania surrounding GameStop, the relationship between a rapidly growing group of retail traders and their big money counterparts, as well as the madness of crowds, and whether similarities exist between this latest phenomenon and events like the South Sea bubble. Hope you enjoy the episode. Welcome back to the podcast, Trevor. Has it been a busy start to the week so far?
Yes, it has been. Monday's always a busy day, starting the week. I have a lot to do on Mondays, and trading-wise, often we get market moves on Mondays. So, yes, it's been moderately busy, but pleasant. Lockdown, but looking out my window on the Kent countryside, which is beautifully white today.
Yeah, I was going to ask you about that. It's absolutely freezing here.
Yeah, it's also freezing.
Yeah, you've probably got more picturesque views than I have. I'm in sort of central London, so not as lovely and white. None of it's really settling around here, unfortunately.
All right, it's now getting quite deep here, which is pretty. At this moment, it's pretty.
Yeah, good. All right, then. Well, I want to get sort of stuck into the topic of the day, and that's GameStop.
Yes.
Yeah, so GameStop shares, I mean, they soared from a few dollars in 2020 to about $480 on January 28th. And they actually went on to sink to 81 by February 2nd and have continued to slide since then. So that meant a firm that was worth $200 million in April last year was briefly valued at $30 billion, which of course then it's since to shed near all of that market value since. So most of the listeners will know those sequence of events, but in your opinion, what caused this to happen?
Well, we know the culprits, which is the Reddit and particularly the Wall Street Bets crew versus the short-selling hedge fund. So this was a phenomena, an extraordinary phenomena. Let's say, I wouldn't. Unusual is the wrong word, but it was a popular challenge between these two parties, and we'll go into the details of it. But I mean, as you said, the numbers are mind-boggling. And actually, on that day, on the 28th, we opened at 265. The high was 483, so nearly doubled. And the low on the day was 112. So that's a range from 483 to 112, and then it ended that day at 193, and of course down now at around about $60. So this is just amazing amount of movements and volatility in a stock.
Yeah, absolutely. And was this the first time ordinary investors possessed the clout to move an asset, a stock in this case, in such a significant way?
I think it's the first time that I'm aware of that they've had success like this, and we have to say it was success. It was a challenge. I'm not a Reddit person, and I'm not a Wall Street Bets person. I know very little about Reddit, except that about 2 years ago, some friends of mine very excitedly told me that something I'd said had reached number 10 in Reddit on some forum, and I said, well, what does that mean? And apparently it was very good. And I went to look at it, and what was it I'd said that got people excited? And it was I'd said something about something in the markets, and what I immediately saw is this was essentially confirmation bias from the group, because the group were very bullish of the thing that I was talking about, and they were looking for support for the bullish case, and they were saying technical analysis expert confirms that so and so, and that was why my mention went so high. But I mean, for me, it was just, you're just looking for news which confirms what you think in the market. But this event that we've seen here was, in my opinion, the first time that's ever happened, that just to such an extent that the whole world knew about it.
Yeah, absolutely. I guess if we are to sort of see this as something that has never happened before, an unprecedented event in certain ways, but maybe not others, and we'll get onto that. The failed short squeeze on silver last week could be then a signal that GameStop was an anomaly, or do you think, we're witnessing the beginning of a new era? Do you expect us to return to business as usual, or actually is this a pivotal point in your opinion?
Well, I don't know what, again, as I say, I'm not one of them, so I don't know what was in the mind of this group to take on silver. Silver, they had a success because silver was ready to break up. So they had, if you like, the technicals on their side. So it was a good moment to trigger, but it was like triggering a stop, in a way. There were many buy orders placed, and it broke through a level which triggered a breakout. It was a significant high. And so in this case, they were doing what those naughty old institutions are accused of doing a lot of the time, front-running a series of stops, which they did. But of course, like any occasion where you try and do that, that's short-lived, unless there's genuine fundamental follow-through or trend follow-through in it, which for the moment there wasn't. I actually think that silver will go up, that it just triggered early a move that's going to take place anyway. But it certainly fell back once the breakout had faded, once the breakout had occurred. And so I imagine that was an expensive experiment for those people. But basically, can it really be that they didn't understand? It's very different from taking on the short sellers, which is a small group of people, very large hedge funds, but individually it's a small group that were shorting stocks like American Airlines and GameStop and so forth. But here you're taking on a big market, has enormous supply and demand at stock level and trade, and to try and corner that market is a very big proposition to try and do that. It happened once in the past with Bunker Hunt, but that was many decades ago.
Yeah, absolutely. And to focus on the other side of the market, then the institutional side of the market, I actually read that GameStop was not actually one of the most traded stocks by retail investors kind of during the market mania last month. So it featured on a list that I believe a JP Morgan analyst put together, and it came in at about number 15 on that list. So kind of, are we yet to learn the full story here? Was it actually retail traders that incited this sort of squeeze, this move alone, or did the institutional participants have a part to play?
I think here it's definitely my own opinion, and I don't know the answer to that. But I think, as a general statement, it was a retail-driven thing. The retail market itself got itself into a lull of excitement, and the bots, were getting people into a great state of frenzy, and so as a crowd, they had massive force. But I think that most other institutions don't really generally take on the particular type of short sellers that we're talking about here, that do a lot of research, and they pick their stocks carefully, and there's a good reason for them to go short, and basically they're just usually hurrying up an inevitable event. And they publish their research, which they did in this case, about GameStop, why it should go down, and usually most people nod and say, well, that's true, and the stock goes towards bankruptcy. But not in this case. These people didn't respect this level of research, and we had this move. So, in my opinion, it was started for sure. In my opinion, it was started by the retail. This movement to take on these people and to give them a lesson, a bloody nose, which they definitely did. They didn't destroy them, but it was definitely singed the beard of the King of Spain, as they say. But don't think it was institutionally driven. It wasn't that. And although the institutions did jump in, I myself jumped in to participate in this game as soon as I saw it was on, and I sold short on it. I thought, well, this is it can't defy gravity, is all I thought. But that was a gamble and a bet on my part, so I was no better than any Reddit investor in that sense.
Yeah, of interest. When did you get involved? Around about?
I sold on the 28th, and if you want to know my exact price, I did it at 265.
Okay. Yeah, interesting.
So not the best price or anything like that.
No, that's certainly not the worst price either.
By the end of the day, it was quite good, and then a couple of this week and the end of last week, it was a lot better. But I unfortunately think that maybe this game has probably hurried the inevitable demise of the company. It had probably happened. Yeah, it was tootling along nicely around $25, and nobody really cared much, and it just carried on losing money, but not quite going under. But here we have constructive, destructive capitalism at play, and I think it just will be sped up now, and it'd probably go under earlier than it was going to.
Yeah, I completely see what you mean. That actually probably brings me on to my next point then. Of course, this isn't the first time a stock's been pushed sort of far beyond its underlying value, regardless of who's actually doing it. We've seen a lot of stocks pushed well beyond their underlying value. But it does seem that trend, that phenomenon is happening with increasing frequency. Does that concern you at all?
It doesn't concern me. What concerns me is that analysis, conventional fundamental analysis, is not keeping up with what is really happening. You say, pushed beyond their value, but what is their value? I'll tell you the value of it. The value is 60.97. That's the balance between the buyers and the sellers. That's what it's worth. And enough people are willing to pay that. And a balance currently by the number of people who are willing to sell it. Now it's moved to 61.23. That's what it's worth. And you can't say it. I can't say it's worth nothing or anything like that, because enough people will pay that price to keep it there. But what's the problem is that the conventional ways of determining the value of things are way behind the times, and they can't account for things like, if we take Tesla for example. Tesla is, to some people, innovative champion company, 10 years ahead of all other car companies, wonderful, dynamic, inspirational leader, and it's in charge of the whole electronic e-car business. To other people, it's a company run by an erratic, the least leader. It's a company that has only just made a first profit. It's a company that couldn't make profitable cars when they had the monopoly over $100,000, and now they're selling cars at $30,000, where they are about to have enormous competition from Mercedes and Volkswagen and so forth. But yet, the share price is, it is what it is. What is it right now? Let me just look at it. Tesla is at, sorry, it took me so long there, is 868.685. And that's what it's worth. But, financial calculations can't value a company like that. It's a small producer of cars, and yet it's worth more than all of the US car industry combined. And yet it only produces relatively few cars. It's got a price to earnings ratio of 1,361. Now, I don't know, many people don't sort of know what that means, but what that means is the current price is discounting the earnings, the current earnings, for 1,361 years ahead. So this price, with the current earnings, is pricing in 1,361 years ahead. I mean, many people would say that's a little bit crazy. Even the S&P was got a high PE at the moment. It's only 40 with an average PE of 15. And so why would people, on what basis is the price there? The price is there because people in their minds believe it is worth it, and all this thing about the guy and the man and it really almost a cult puts it ahead of Toyota and Ford and other companies like that, who have big factories, employ thousands of people, produce cars all over the world, and produce many, many cars, and will be their competitors very soon. So it's very difficult to use conventional calculations. And if you're doing a CFA, you're learning things, but on the background, people are saying, but of course, in real life, it's not like this. And I liked a friend of mine was showing me on a Zoom call. He's got a new mug, and he's a fundamental analyst, and he got a mug, and it said EBITDA-C. And what that stands for, EBITDA, you may know, stands for earnings before interest, taxes, depreciation, and amortization plus COVID. Because everything that was calculated pre-COVID changes with COVID. So you can't base any analysis of a company because basically there was a sudden full stop there. And so you can't average the past and say that will be what happens in 2021 anymore. All the calculations simply don't work. But that's why, as a technical analyst, I'm pleased about this, because what we've got on our side is we understand that people make the price. Tesla is what it is because people like it and buy it intensively. GameStop does what it does because people gang up and decide to do what they're doing. These are factors, just like any other factor in the market, and we chart the value of price. Not the value of price. So we chart the action of the price, and that tells us the action of the buyers and the sellers, and how supply and demand, hope, fear, greed, expectations are valued at 868.899 in Tesla right now, and that is exactly what all those things equal.
Yeah, absolutely. I mean, it's a fascinating time for sort of fundamental analysis and whether it's actually going to be able to keep up with the times. I don't know whether you see, obviously, as you say, you're a technical analyst, but whether you see sort of peers kind of transforming the way they look at the market, they look at stocks in particular. I've spoken to a few people on this podcast about sort of how they mine alternative data, social media feeds, market sentiment, that sort of stuff, and whether actually that's going to be more relevant to stock market analysis than traditional fundamental analysis. I don't know whether you've got an opinion on that at all.
Yes, I do. I mean, I think clearly it's very important to understand the mind of the social media mind. To me, it's a foreign guy, an alien, this person, and that it's a force there, and we must know what the aliens are thinking. But we can read that, and I have in front of me right now a very sophisticated program for reading and analyzing social conversations, keywords, and rating them, and rating groups and their average for getting things right and getting them wrong. And the ones that get it wrong a lot are actually very useful. And using very sophisticated algorithms to analyze the chat, the conversation, the Hubble of conversation. But with powerful computers, we're able to do this now. I think this is without doubt, because that is now a factor. And we can defy gravity if the Reddit crowd, I won't call them the aliens, decide that it's going up, and there's enough of them to do it, and they have a lot of power. And we've seen this has been growing. It's not in itself, I suppose, it's not a surprise, but it was a surprise in that it had never happened before, and it caught all the risk models wrong-footed. This is, has never been put into any formula as a risk. It didn't exist. It's a black swan, a true black swan, something you couldn't have imagined happening in the market, but it's a reality. But that too makes it, now not so much of a shock. And so once these things become expected and factors, they may be more difficult for that type of event to happen again.
Yeah, absolutely. I'd point just at this point, I'd point our listeners to our Chris Camillo interview. He's a guy that actually created a tool not too dissimilar to the one that you were describing there, called ticker tags, that I believe a lot of the institutions use. And again, that helps them mine sort of social data using sort of NLP and things like that.
Yes, there are several, and the one I'm looking at is the Refinitiv one, which is on their terminals.
Right. Okay. Yeah. Okay. Interesting. Well, I mean, the whole reason this sort of trend and this alternative data question that we've just sort of posed there has come about is because I guess that the access to global equity markets has never been easier or cheaper. I mean, you can buy a stock on an app whilst you queue for a coffee, for example, for close to the wholesale price. You know, there's not really any extra fee there at all now with apps in the US like Robinhood, for example. So do you think this has had a fundamental impact on the kind of underlying dynamic financial stock markets?
Yes, it has. It's been the if we call it the Robinhood revolution. I know it isn't just Robinhood, but you know the very, very accessible type of trading that has come. It was been moving towards that for years, but now, and Robinhood itself has been around for a bit, but now it's really a huge thing. Maybe COVID and people having a lot of time on their hands and finding, playing gambling, is just really boring. We need to speed things up a bit, and finding this great to participate in. And I think it is here to stay. What you've done is introduced new participants into the market, younger demographic, and they might have felt that it was very inaccessible, difficult. Lots of difficult forms, and you had buying and selling very, very difficult. Now it's just it's an app, and it's easy to open an account and off you go, and they'll let you do anything until you run out of money.
Yeah, absolutely. And just to quantify it, I read an article earlier today that said as much as 25% of total trading volume in global equity markets in recent months was 25%. You could attribute that to retail traders. I mean, that's nearly a quarter of the market attributed to retail trades, which is unprecedented. So, I mean, do you have any thoughts on whether you expect that percentage to grow?
I hope it does. I think it's a good thing. Forgetting this individual event, but the democratization of trading, I think, is good. The fact that people hopefully will be students and will learn to do serious analysis and not just, let's say, gamble and challenge the establishment, but actually think about their future and the pensions and investments, and will now feel that they can do it for themselves and do it well for themselves. So I don't think it's a bad thing. What is a bad thing is that lots of people would have got hurt and they didn't understand what they were doing. They were encouraged, they were goaded, and I'm sure amongst that 80% drop in the price, there's been a great deal of pain, because most of the people who bought that speculatively didn't pay the low prices. They didn't pay $25 and $30. They bought it at several $100s, and they briefly were very rich, and then they lost a lot. And that will be much the majority. There won't be too many people who will claim to have walked away winners on that. There was only a very short moment when you could have sold to be one of those spectacular winners. The younger, newer investor has, in recent years, already had a big impact, a really, really big impact in another area, in which is the move towards ESG conscious investing, and so much so that many institutions are in quite a panic to restructure their product lines to get into line, and fearful of being singled out as an evil bank or something like that. And so they're cleaning themselves up, and that is due to a ground up swell of demand and saying, well, I want my pension to be invested with a conscience, and I don't want to to use blood diamonds and invest in those sort of things. And we've seen a revolution, and this has been driven by a younger demographic, the new pension holders, if you like, and pension buyers, and the institutions have had to very rapidly adjust to this new phenomena. So this is a different phenomena, but from another group of people, much more broadly based, but still with a focus on taking on the establishment. The establishment wasn't delivering them what they wanted.
No, yeah, absolutely. I think we can definitely say that's the case. And I guess with nothing to be gained on savings accounts and the rate that you get there and things like that, people are just sort of aggressively going after kind of returns anywhere they can get it. And as you said earlier, with the amount of time that people have got on their hands, particularly if they're furloughed, for example, but at least they're at home, so there's no commute time there as well. There's ample opportunity to start trading. And the access is there and unprecedented, as we talked about. But maybe a trend, or a trend's the wrong word, a philosophy, I guess, that we can sort of attribute to this phenomenon, hopefully. And it's one that we discussed in our Opto Sessions interview at the beginning of last year. It's crowd theory, broadly speaking, but the Extraordinary Popular Delusions and the Madness of Crowds is a book written, I think it was first published in 1841 by a guy called Charles Mackay. We did discuss it in the original interview, but I imagine people have forgotten, and we will have collected a few new listeners since then. So do you think that book, the kind of theories that he talks about there, and are kind of more relevant now than ever?
I think they continue to be relevant. So since the book was published in 1850, there have been a series. I count at least 10, but there are probably many more bubbles. So he would have added more chapters to his book if he was writing the book today. But I wonder whether this particular event fits the mold properly. And I have thought hard about this. So was the GameStop bubble, let's say, a classic bubble? Well, I think it wasn't actually. I think it may have been genuinely a change that's taking place. And I don't know if we got time, but the characteristics of a bubble. There are characteristics. They're repetitive from the tube crisis and the South Sea bubble and the Mississippi crisis, and as you go on through history, they all have things in common. And this one has a few missing from it. So one of the things is this time it's different. It's often technology in some way related to new technology, and this was definitely the opposite of that. It's really this particular one was to do with old technology and like a revival of vinyl records or something like that. So it doesn't tick that box. There's always been in the classic bubbles no moral hazard. Moral hazard in the sense that if people invested, they would be rescued if anything went wrong. The government or was there to rescue them. And this wasn't the case here. Easy money, well, it ticks that box. It's in the era of easy money. Overblown growth stories, well, it doesn't support that one. Nobody really thought that GameStop was going to become profitable as a result of this. Also, another one is in these bubbles, there's no valuation anchor. You can't say that the tulips can't go up more than so-and-so because daffodils are priced at so-and-so. There was no anchor. In the bubbles, there's nothing you can say, this is like that. It's something different. So here too, you have got anchors. It usually happens in a period of conspicuous consumption. So people have got loads of money and they're flashing their cash around, and that sort of excess. Don't think that's really the case. The best way to monitor that is through the price of art. So probably art confirms that we're in conspicuous consumption era. The Ponzi financing of it, well, we could probably tick that box. The decline in credit standards, we can tick that box. Irrational exuberance, we can tick that box. And then gurus and leaders, influencers, and we can tick that box because there were individual people who were the, we can identify as the leaders. And I don't know if you know who one of the leaders was of the South Sea bubble. It was Sir Isaac Newton, who lost a fortune. In the end, he was living off the generosity of his friends, and he lost a lot. And that's quite often the case. It's very intelligent people that are actually part of the bubble itself, the driver of the bubble. So I'm thinking about it, and I think that it's maybe doesn't go into the book of Popular Delusions book, this one, because it doesn't really exactly look like a bubble, actually. It's something else.
Yeah, it's something else. But that's something else, whatever we can call it. Do you expect that to happen again?
I personally don't. I think that they've shot their bolt. But again, this is my opinion, and I can definitely be wrong about this. But I think they've shot their bolt here. Everybody's watching now. My computer is watching. I didn't really look at it, and now I am looking at studying the chat on Reddit and other influencing places like that, and people will hope, I think, that they will try and do it again, and they'll try and go against it the next time. But particularly if they pick some no-hoper stock like that, nobody was happier about this than American Airlines and AMC. Both of them used the unexpected bonanza of the blip up in their stock to issue new shares. They must have been happy to speak.
Yeah.
I never expected that.
Yeah, absolutely. Yeah, no, that's fascinating. It's really, really interesting sort of way, sort of comparing it to historical events. It's not something I've heard reported elsewhere in the financial media. People just focusing on this being an unprecedented event. But actually, maybe it is something different. But to compare it to stuff that's happened in the past is a really interesting way to look at it. So thanks for sharing that.
Yeah, it's a pleasure.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show. And to move us on to kind of the murky waters, I suppose, of market manipulation, it's something we've discussed between ourselves previously. And there's ongoing sort of speculation around manipulation with the GameStop trade and just sort of the Wall Street bets community as well, but actually that applies to the hedge funds. I've seen sort of questions asked of them as well. But when we discussed it again in this early interview early last year, which people will be able to find on the feed, so certainly go back and have a look. You were fairly emphatic at the time. The potential for manipulation is limited, extremely limited. Do you maintain that view now?
Well, I think it was manipulated, but by the Reddit people.
Yeah.
Clearly it was, that they had a goal, and it was to manipulate the stock higher, way above any measure of its worth, and really for the purpose, I think, the mischievous purpose of teaching these evil hedge funds that short stocks a lesson. The evil hedge funds themselves played the game fairly. They did their research, which was serious research. They didn't make it up about that company, and published the research. And basically, the manipulation, if you like, is people read the research, institutions, and they nod their head and say that's right, and that's why it goes down. But basically, they're only, they're not lying. Otherwise, people wouldn't then sell it. They wouldn't follow it because they do check it. And so in that respect, they're transparent, and it's actually being transparent is what they're doing. They're saying they're revealing things that people don't appreciate and making it clear and bringing it to people's attention. But on the other side, I think we had a clear attempt to manipulate the stock higher. So interestingly, it's not the institutions that are the bad guys. If it is a bad guy to manipulate the stock, it was the average Joe Public
Yeah.
was the bad guy.
Yeah, it's interesting because I was doing a bit of reading online, and it seems like the grouping together of individuals to discuss an idea. I mean, hedge funds do this on a regular basis. They talk through kind of ideas and share ideas, share trade ideas. And that's obviously going online all day, every day on Twitter, Reddit, etc.
Yeah.
It's actually once you sort of add that intention of, as you say, sort of sticking it to the hedge funds, and that kind of, it's that sort of more illicit intention of manipulating the stock higher for that less than positive purpose. That's kind of where the murky waters start, I think. But obviously there's ongoing investigations into this, so we'll see how that pans out.
Well, if the institutions did it, colluded to manipulate it, they would all be heading for jail.
Well, absolutely. Yeah, exactly. Yeah, okay, well, it's an interesting one. We'll see how that story pans out. Well, we've kind of touched on it there, I think, the sort of this interplay and this relationship between the retail audience and the institutional audience. And actually, we ran an extremely popular video on our YouTube channel. It was after an event last year where you discussed this relationship. We explicitly focused on it. You discussed a private trader's advantages and disadvantages versus their institutional peers. And of course, this relationship has been thrown into sharp relief with the recent short squeeze on GameStop. So we've seen some big hedge funds incur heavy losses, like we discussed earlier on. They had to exit their short positions in GameStop because of this retail incited squeeze, I suppose, is the way we've kind of described it during the call. So can retail traders take on big money, and can they win now?
Well, they nearly did with this. I don't know whether I'm right to say that they didn't win, but to me, I don't think there were will be many people who walked away big winners. Many people say I made, my account had, 30 million in it at one moment, but I don't think there were 30 million in it by the time they cashed it in. I think that will be a very small group of people that won on that. Most people will have lost. But it's definitely, when I gave that talk, I basically, one of my themes was that the institutions basically ignore the retail investors. They're just too small. They don't mean anything, and what they do doesn't matter. What they do. Well, that wasn't right, was it? Here they ganged up together, and they were a force. And to a few hedge funds, only a few. Don't forget, it's not the whole hedge fund industry. Most of the people don't do that. But they did stick it to those particular hedge funds, and so they were a force, and they will be, and they are growing. And as you say about the volume, they are becoming a force. There's been many clues towards that. Actually, the commitment of traders. See at the COT reports. You could years ago you could reliably say when you had big build-ups of longs in the small investor, the retail investor in a bull market, and a build-up of or a liquidation going on from the large commercials, that would be a top in the market because the retail market guy was always the last person to buy. Actually, this isn't true. This isn't true at all. Actually, the retail guy as a group, as revealed in that data, has got a lot better. And I think the commercials haven't got a monopoly at selling at the top and the bottom in the way they used to have. So, there's been an improvement, if you like, in the behaviour of the retail investors, which we've seen over years in other futures markets where we have the COT data. So I would retract that where to say they don't take any notice. I think they will take notice from now on. But they're clever people, the institutions, and they've got powerful computers, and they'll be watching, and they'll spot it, very quickly in the future.
Yeah, absolutely. And as a aside, I suppose, do you think we'll see fewer short focus funds, I guess, more particularly moving forward? It just seemed that this sort of retail incited short squeeze, exposing some long held positions in the hedge fund space, like you discussed there, it seemed like that sort of lessened the investment case for these sorts of funds going after those sorts of positions a touch, given how sort of unruly and unpredictable the retail trader base can and probably will continue to be moving forward. I wonder whether you had any thought on that.
I don't think it will stop it. I think it's in a odd sort of way they have a function, of revealing the worth of companies and perhaps hastening this transition, this capitalist effect, which is destruction. But I mean, that is how it is. That's capitalism, really. The high street, it ends and maybe ends sooner as a result of COVID, but does something that was going to do anyway. It's a destructive effect, and so it's called, Joseph Schumpeter's creative destruction economics. It is the nature of economics, and this is just one of the ways it's done. You have to reveal these kind of zombie companies, and there'll be plenty more of them after COVID, that are just hanging on because they're getting government grants and things like that, but actually will never have a business afterwards. They're actually finished now, but the government is holding them up, and their staff are furloughed and things like that. But there's going to be lots of zombie companies after this event. So I think, no, I don't think it'll go away at all. And actually, I don't think it's a bad thing.
No, I'd agree. I just wondered whether, because they hadn't had to deal with such a large sort of unpredictable segment of the market before, it made them think twice about going after these positions. But actually, in the current environment, there's going to be more of these trades to be had, I would imagine, as kind of you were alluding to there.
I think their models will alter, because they now have a new risk factor, and it won't be a 1 in 20,000 year event anymore. It will be something which can happen, and they'll factor it in, and they'll look for the signs of it. It's a hazard. They don't always win, that even before this, they don't always win, because they leverage up on the short side. And it's quite expensive to run shorts, and so there's time is against them. And if the rest of the world doesn't agree with them quickly enough, they have to cover. So it's nothing to do with the private guys. They don't always win.
Okay, well, going back to the interview that we just sort of highlighted there, you gave it at the Opto event that I referenced, and within that you identified an individual participant's sort of ability to, if I quote you right here, to trade wholesale, not retail. And it was an interesting idea, and one that captures this dynamic where at any given point, retail and institutional traders are often trading in opposite directions. I wonder whether you could sort of explain that idea to the listeners. It seems quite pertinent now.
The institutional trader works at some considerable disadvantages in some respects. Although they've got low transaction costs and they're very close to the market and they've got lots of money, but actually they have to work with lots of money. Therefore, it's hard to make, money. They can't do many of the trades the private investor can do, because they're very flexible, in, out, things like that, unless they're using a high frequency trading program. But if you think of something like this, and this is what specifically what I was talking about with the wholesale and retail. If you think of a market which is coming to a support level, so it's a level where it's a previous low or something like that, that means the same to a retail guy as it does to a institutional guy. So how does it behave at that point? Now, you might see how the bars are evolving. You might be looking at 5-minute bars, hourly bars, daily bars, something like that, candles, and you might see that at this horizontal support level, the market is the bodies of the candles are getting small, so there's sort of no conviction during the day. The shadows are all below the line, and you may say this looks like it's going to hold the level, and then maybe there's a white candle, nice white candle, the support has held, and you might say, if the market moves ahead of the high of that candle, I will buy. And that would be a conservative, good way to say a support level is hold. Of course, it hasn't held until it's moved away from the support itself. So you have to wait for that strong white candle to get the confirmation. And maybe you're conservative enough that you want some follow through after that one white candle at the support level. Now, on the other side, how would the institutional trader behave looking at the same event itself. Now, he cannot afford to wait and to buy his position when the white candle forms and we break the high of the white candle, then start to buy. He's going to buy so much that it's going to push the market up. He can only, if he wants to get on a large position, a meaningful position, a position which is if he's right, makes him a serious amount of money, then he will start to buy early. That's dangerous, of course, but on the early signs of it. And he will try and buy while the market is offered, not while it's bid, as it would be when you've had that white candle there. The market's all gone bid and everybody's a buyer and all the sellers are withdrawing. You want to buy into the end of the fall. So they'll be using, momentum indicators like the stochastic, for example, or more sophisticated things. But we're trying to catch the last part of the sell-off into the resistance, to use the offers of that last part to accumulate a large position. They will also buy the bulk of their position early and reduce the amount as the price goes in their favor. And that's typically exactly the opposite from what retail investors do. Retail investors, when at the beginning they're not sure, so they buy small. Let's say they buy one lot, then it starts to go in their favor like they thought it would do, so they buy another couple of lots, so now they've got 3, and then it's really moving in their favor, so they double up and now they've got 6. But what they've got is an average which is very close to the current price. The institutions will do that in reverse. Let's take the same size. They will buy 3, then higher up 2, then buy 1. So the average is close to the initial price, and therefore they've got more room and they can have their stop further back. And then by the time that white candle has appeared and you're breaking the high of that white candle, and as a retail investor, you're now entering the market, saying that the support levels hold. That's probably the time that the institutional investor is selling, because he's taking his profit on the move. And so, this is if you like, the wholesale attitude as opposed to the retail attitude of trading. So try and become closer, as a retail investor, become closer to the wholesale and think like the wholesale, not the retail. Don't pay retail.
Yeah, no, exactly. I thought it was such an interesting time to re-examine that dynamic and that kind of mindset of thinking wholesale rather than retail. So if I move us on then to one of my final questions before we move on to the quickfire question round, which is where we'll finish the interview. This relationship between retail and institutional, if you want to frame it with those two words, I'm just interested to see or kind of get your thoughts on how that develops. I mean, to me anyway, it seems relatively antagonistic. I think probably more so from the retail side. As you say, I don't imagine the institutions care too much for what the retail traders think of them, but certainly from the retail traders side, it's felt fairly antagonistic. They frame them as the enemy, at least the Wall Street Bets subreddit positioned these big hedge funds as the enemy when they went after their short positions. So I just wanted to get your view on kind of how you see that relationship developing, whether we're going to see more antagonism going forwards. What's your thought?
I think it seems like the mood is on for that, but it will come from the retail side. Maybe smarting from losses, and determination will increase to do it better next time. And there are many smart people in there. Maybe silver wasn't a smart one, and that was fairly obviously not going to work. But I think that was clever, really, to pick on a group of people that felt they weren't vulnerable, the short sellers, only to other institutions not following their lead. That was their only risk, really. And then this new phenomena, which was this angry crowd, came in and took them on. And so I think for a while anyway, this will continue. It may end in the loss sickness may set in for these people, and they may say, better get a better job, a proper job, and and but we'll have to see. Maybe they'll hit a splendid success. But I think they've, I'm not against all this, because I think it's actually, we've learned a lot of lessons from this. I think that they've done a lot of things which I think would be quite helpful and will have an impact. I don't know if maybe I'm answering the next question, but the clear benefit is the increase in liquidity, more participants, more new participants learning about the markets, people doing it for themselves. I think that's a good thing, that people can feel they can do that, and learn that a bull market is not being clever. It's just a bull market, and markets go down as well as up. But all these lessons hopefully are learned without fatality. But I think there are a couple of other important things that are going to happen as a result of this, because it really, really showed up a big shortcoming in the settlement system in equities. The 2-day settlement, in the US for equities, caused this problem of the brokers not being able to service Robinhood, and Robinhood having to close out and to cut off its clients and not take orders and things like that. And so this was a real problem for the market makers, and those that service Robinhood itself were really exposed. Robinhood is not a big company. It's not a well-financed company. It had to recapitalize itself during the whole process itself. A lot of these companies, the reason they are more expensive than Robinhood is because they have to maintain the capital and be the large companies that takes the strain of this kind of thing. But I think the 2-day settlement was always crying out to be shortened. And I remember 2 years ago I went to a talk, and I better not name names, but because the people are all quite well known and they might sue me. But on the podium was a person from a very big stock exchange, and also somebody I will say from NASDAQ, and they were talking about the settlement and the blockchain. So the actual subject of the talk was the blockchain, and people were saying, why don't you settle? Because technologically, there's no reason that it takes 2 days to settle. You can settle almost instantly. You could settle 50,000 times a second if you wanted to do that. And NASDAQ guy was saying that they were doing that, and they had established a subset of the exchange to actually test this, and this was definitely the future as far as they were concerned, near instant settlement. But the person from the other exchange said that they thought the blockchain was the solution without a problem. It's working fine, 2-day settlement, so why spend billions or millions to change it? And I think the answer to that is this is the reason why, because the system nearly broke here, and it will happen again. And so really they need to set 2 days is archaic as a settlement process, isn't it?
Yeah, absolutely. For me, that seems extraordinary that someone in that position would kind of be that short-sighted.
Yeah. Well, that's it. Those were the very words. A solution without a problem.
Wow. Well, there you go. On that, I think that's quite a nice place to end, actually. I'll move us on then to our quick fire question round. So I don't think we did this, or we might have done a version of this last time you came on the show, but certainly the questions will have changed. And this is just simply a lighthearted way to end the episode. Feel free to answer in as little as one sentence or even one word.
Okay.
My first question to you is, what is the top mistake investors make?
Okay, and here to answer the question specifically about the retail investor, is they focus on the reward and don't consider the risk, and that's why so often it goes awry.
Question 2 then, where do you go for investment or economic insights? Do you read any specific publishers, for example?
No, I try and avoid that, oddly enough. I'm a technical analyst, and everything I need to know is in the price. And fundamentals are therefore a distraction. And I find it like very easily to think that my opinions are my own, but it's really something that I read somewhere, and I think, I thought of that, but I didn't at all. And so I'm quite careful about that. However, I can't live in a bubble. I don't live in a bubble, but I only read the FT on a Saturday, and so basically, I find out what happened and why. What was the fundamental reason? But I mean, basically, I know what happened because it was the price. And if the price went up, there was something bullish that happened. So it's not really important to know what it was, that news. And, I don't think that we're particularly well served by a lot of the big publications anyway. So I don't read publications to get any inspiration or insight about the markets. I think everything I need is in the price.
Yeah, no, well, that makes a lot of sense. So question 3 then, what is the most memorable moment from your career to date?
I think that it was when I was trading for the hedge fund in South Africa. We traded very, very intensely there. We were big traders in the market. We did about 3% of the turnover of the Johannesburg Stock Exchange, which is quite a big stock exchange with big stocks, Richemont, Anglo-American, Anglo-Platts, all the BHP, primary listings there. And we were very big in that. And we day traded those things, and we sold them short, borrowed and sold short. And I was working really, really hard doing that. We were doing really well, making a lot of money, best performing active hedge fund in the country and all that sort of thing. But I'd never worked so hard since I was in my 20s, and it was exhausting. And, I was dizzy at the end of the session. But on the 7th of July, 2005, you remember the terrorist attack there. One of the things was the bus blew up in Russell Square. My son lived in Russell Square, and I was quickly on the phone to try and get hold of him. I couldn't get hold of him. He wasn't answering the phone. And my partner said to me, he said, "Get off the phone." He said, "If your son is dead, you'll know at the close." And our clients expect us to make this should be one of the biggest days of the year financially for us. That's when I realized I had to get out of that hedge fund and return to the UK and operate my own.
Yeah, I mean, that is quite extraordinary to hear. Wow. Yeah, that's going to live long in the memory for sure. Okay, then, well, hopefully to a slightly more positive note, a top tip for your younger self.
Yeah, what one would like to say, I should have bought Apple and, and held on to it. But that would have never happened. There's no point in saying that, really. I remember Apple starting, and I remember I had an Apple computer, Apple II computer, so before the Mac came out. Apple was always a dodgy company. It was very questionable whether Apple would be able to survive. Why do people want to continuously pay 50% more for computers for a locked-in system when they've got an open system like the IBM system that you can buy any old computer and any old bits for it? And so, it was very questionable. It was only when the iPhone came out that really you could say that company is not going to go bankrupt. And it's worth it. So I can't really say I should have done that because I wouldn't have done that. I didn't. I thought it was actually probably going to go bankrupt. But I would say that to answer your question more succinctly and correctly, the tip for my younger self is I would properly understand the awesome power of compound interest, which I've through my life continuously failed to appreciate. And you know what that means if you have a long career and a long time participating in the markets, even as a house buyer or just in that sense of the word. Don't underestimate, and really people do, even experts do, the awesome power of compound interest.
Absolutely. That's one that we've potentially had in this section, but certainly discussed with a guy called Morgan Housel that does a lot on sort of behavioral psychology and things like that, but it's just not an intuitive concept.
No.
So I think a lot of people struggle with it.
Yeah, even experts.
Yes, exactly. Okay, final question then. This is sort of the Opto question. We strive to speak to people that sort of outperform the markets or are looking for sort of alpha above and beyond sort of benchmark returns. So, in your opinion, what is an investor's best source of alpha?
I think first of all, investors should take trading seriously, and I think that most of the participants in retail participants are in it for entertainment, and that's not a bad reason, to be in it. But they don't they think it's serious because of the business itself. But trading and investing is a serious business, and it should be treated like a business. And you should think about the plans and the risk. Use the advantages you have as a smaller investor, which is your smaller size, so you aren't having to cope with the problem of executing orders. Trade in a time frame where you have an advantage, you have no disadvantage, like end of day. End of day data is the same end of day data for an institution as it is for a private investor, and you can probably do the analysis better. I work with institutional traders, and they are not as clever as sometimes you might think. You've got the advantage you can diversify. A lot of them can't because they are I'm a copper trader, and that's all they're allowed to do is copper, and that's a big disadvantage to them because copper could be nothing or to do in it, or it's a lot easier if you traded Vodafone, for example. Please respect how much capital you need in order to survive in this. You've got to realize that you're not going to win every time, and losses are normal. And if you can't take those losses and it's game over, then you're definitely going to be out of the game. I suggest also be systematic, rule-based, and develop a computer program to help you do the things which make sense in a rigorous, disciplined way. And then finally, do all the thinking about a trade in advance of the trade itself. Leave nothing that you're going to do to be done during the trade. Only before the trade can you think clearly, because you haven't got a P&L, you haven't got your heart racing at all. You haven't put any money into the market. You can plan your if the market moves to here, I'm going to stop out. If the market moves to here, I'm in my favor, I'm going to raise the stop. If my stop moves above my entry price, I will do something else. And all that, try and think as far ahead as you can and then make the trade. Therefore, everything during the trade is just a process. Next, I have to do this. Next, I have to do that. All the thinking was done when you could think clearly. You can't think clearly when you've got a position. So think, why do footballers ever miss penalties? It's because of the pressure of the moment. Something is easy, good, they're highly paid, they've done it 1,000 times, but they can mess it up. Why? It's the pressure of the occasion. And so do everything you have to do before the pressure of the occasion.
Absolutely. Some really valuable advice, actually. I think that's a perfect place to end the interview. So thanks very much, Trevor, for joining us on the Opto Sessions podcast again. It was a real pleasure for me.
Thank you very much. Thank you very much indeed, Hayden. Great pleasure, as always.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends, and in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time. I'm Hayden Brain, and you're listening to Opto Sessions. Today I welcome back Trevor Neil. During today's episode, we discuss the market mania surrounding GameStop. A trader for over 50 years, having started out trading commodities with Merrill Lynch in the mid-1970s. We first spoke in April last year, and Trevor has since appeared on the show to discuss his innovative new trading product, the RRG UK Momentum Plus. Links to both of these interviews can be found in the episode description. Hope you enjoy the episode.